Hey everyone, and welcome back to the channel. Today we're diving into a fascinating corner of the investment world, a place where fortunes can be made when others see only failure. We're talking about distressed investing, and our guide is the incredible book, The Distressed Investing Playbook by Joseph E. Sarachek. Now, I know what some of you might be thinking. Distressed investing? Isn't that super risky and complicated? And you're not wrong. It involves buying the securities of companies that are in or near bankruptcy. But Sarachek, a true legend in this field, breaks it down into a practical, actionable playbook. This isn't just about buying low and hoping for the best. It's a strategic game of chess, and today I'm going to share some of the core principles from his book that can make anyone a smarter, more disciplined investor, even if you never touch a distressed asset. First things first, what exactly is distressed investing? Imagine a company that's been a household name for years suddenly hits a wall. Maybe they have too much debt, face brutal competition, or made a few bad business decisions. Their stock price plummets, their bonds trade for pennies on the dollar, and panic sets in. While most investors are running for the exits, the distressed investor is calmly walking in, looking for value where no one else can see it. They're not just betting on a comeback, they're actively participating in the company's restructuring to unlock its hidden potential. Sarachek's first major lesson is the importance of what he calls finding the fulcrum security. This sounds complex, but the idea is simple and brilliant. In any company's capital structure, you have different layers of debt and equity, like floors in a building. When a company is restructured, not everyone gets paid back in full. The fulcrum security is the level in that structure that is most likely to be converted into the new equity of the reorganized company. It's the pivot point, the exact spot where the old company's value breaks and the new company's ownership begins. Why is this so critical? Because if you own the fulcrum security, you essentially get to own the restructured, healthier company coming out of bankruptcy. If you invest above it, you might get paid back in full, but you miss out on the massive upside. If you invest below it, like in the old stock, your investment could be wiped out completely. Identifying this fulcrum is the first step in separating a golden opportunity from a catastrophic loss. It requires deep analysis of the company's debts, its assets, and its potential earning power after it sheds its financial burdens. This leads us to the next key takeaway from the playbook. You are not a passive stockholder. In distressed investing, you are an active owner. Sarachek emphasizes that the goal isn't just to buy cheap debt, but to gain influence over the restructuring process. By owning a significant chunk of the fulcrum security, investors can get a seat at the negotiating table with other creditors, management, and the courts. This is where the real value is created. They can help shape the new business plan, select the right leadership, and ensure the company emerges from bankruptcy with a clean balance sheet and a clear path to profitability. It's a hands-on approach that turns a financial crisis into a business-building opportunity. But how do you know if a distressed company is a diamond in the rough or just, well, rough? Sarachek provides a powerful framework for analysis. He stresses that you must look past the immediate financial chaos and evaluate the core, underlying business. Does the company have a strong brand, a loyal customer base, valuable patents or real estate? Is the business fundamentally sound, just burdened by a bad balance sheet? This is the crucial distinction. You're not buying a failing business, you're buying a good business with a failing financial structure. A restaurant with terrible food won't be saved by a new loan, but a great restaurant struggling with high rent and old debt has a fighting chance if those issues are resolved. This process is a masterclass in forensic accounting and business valuation. You have to become a detective, digging through financial statements, legal filings, and industry reports. You need to understand what the company's assets are really worth in a liquidation scenario. This is your margin of safety. Sarachek teaches that you must calculate a conservative estimate of what you would get back if everything went wrong and the company had to be sold off for parts. If you can buy the company's debt for less than that liquidation value, you have a built-in cushion against loss. Your downside is protected, while your upside, the successful turnaround of the business, remains enormous. Another lesson from the book, which applies to all types of investing, is the critical role of patience and discipline. Distressed situations are messy. Bankruptcies can drag on for years, filled with legal battles, unexpected twists, and nerve-wracking volatility. The headlines will be terrifying. Other investors will call you crazy. This is where emotional discipline is paramount. Sarachek's playbook is a system for making rational decisions in an irrational environment. You stick to your analysis, trust your valuation, and ignore the noise. The market's panic is your opportunity. Your calm is your edge. Many people lose their nerve and sell at the worst possible moment, right before the turnaround becomes clear. The winners are those who have done their homework and have the conviction to see it through. Let's talk about the human element, because Sarachek highlights that this isn't just a numbers game. You're dealing with management, employees, suppliers, and other creditors, all with their own interests. Understanding the motivations and psychology of each group is key. Who wants to fight? Who wants to cooperate? Can the current management team be trusted to lead the turnaround, or do they need to be replaced? Building relationships and understanding these dynamics can be just as important as analyzing the balance sheet. A successful restructuring requires aligning these different interests towards a common goal, saving the business and creating value for the new owners. It's a high-stakes negotiation where social intelligence can be a huge advantage. So, what can we, as everyday investors, learn from the Distressed Investing Playbook? First, the principle of looking for value where others see fear. Whether it's a stock market correction or a single company hitting a rough patch, don't just follow the herd. Ask yourself, is the underlying business still strong? Is the market overreacting to short-term news? Second, the importance of a margin of safety. Before you invest in anything, ask yourself, what's my downside? Understanding the liquidation value of a business or having a conservative estimate of a stock's intrinsic worth protects you from losing your shirt if things go wrong. Third, the power of being an active, informed owner. Don't just buy a stock and forget about it. Read the annual reports. Listen to the earnings calls. Understand the capital structure and who holds the power. The more you know about the business you own, the better decisions you'll make. And finally, the necessity of patience and emotional control. The greatest investment opportunities often come disguised as terrifying problems. Having the discipline to buy when others are panicking and to hold on through volatility is what separates good investors from great ones. The Distressed Investing Playbook is more than just a guide to a niche strategy. It's a deep dive into the art of business valuation, negotiation, and strategic thinking under pressure. It teaches you to be a contrarian, to do your own homework, and to find opportunity in chaos. Joseph Sarachek provides a masterclass in separating a company's temporary problems from its permanent value. By adopting this mindset, we can all become more resilient, disciplined, and ultimately, more successful investors. I highly recommend picking up a copy of this book if you want to take your understanding of finance and business strategy to the next level. It's dense, but the insights are pure gold. That's all for today, everyone. I hope you found this breakdown valuable. What are your thoughts on distressed investing? Is it a strategy you'd ever consider? Let me know down in the comments. I love reading your perspectives. If you enjoyed this video and want more deep dives into the best books on investing and finance, make sure to hit that like button and subscribe to the channel so you don't miss a thing. Thanks so much for watching, and I'll see you in the next video.